Hey guys, so I wanted to do this quick video. If you don't know me, by the way, I'm Ryan, founder and CEO of Rollups.com and Acquisitions.com. We've been involved in almost $1 billion worth of transactions at this point. I wanted to make this quick video. It's a financial model that I think would be really helpful if you're just getting started. It's the simple way to just look at deals, look at the most important things, and just move on and see if the deal is good or not. Right. So let me show you what that looks like. Here are the things you need to understand. Sorry. So this is the suggested purchase price. This is kind of like what you're going to offer on the business. If there's an asking price from the broker, then you need to figure out if you want to negotiate or whatnot. So I just put 4 million here, right? EBITDA, I put 1 million. You want to put the last 12 months or average of the last 3 years. Obviously, you need to learn how to calculate EBITDA and make sure that the broker is not screwing you. So just make sure you dive into the numbers there. And then it's going to auto calculate the multiple of the deal, right? Then I'm going to put here the loan. So I'm going to write down what percentage of the deal is going to be a loan, basically debt. And that could be a loan from a bank or institutions or your friend. I'm going to put the interest rate. I'm going to put the amortization, basically the years of the loan. And then it's auto calculate the loan amount, right? So let's say, just to show you, if I'm putting 19%, it's 90%, it's going to change it, right? Or if I'm putting 60%, it's going to change it just to make sure that it's accurate, right? And obviously, if you're making a different offer, you can put a 2 million here. Sorry, that's 200 to tuck. Every zero counts, right? So this is what it's going to look like. So you put the interest rate. Obviously, you want to negotiate the interest rate with the bank or with your family member, with your mom if she's giving you the loan. Hopefully, your mom is going to give you a better deal than this. But you got me, right? Seller financing. This is what you're going to put as far as what the seller. So on most deals that I see right now, the seller will finance at least 5 to 10%. So you can put it here. Interest rate can be 10 or 0, obviously, whatever you can negotiate. The lower the better for you as a buyer, of course. And again, amortization, the amount of year of the loan, right? So again, you put everything in yellow, and then it's going to auto populate the rest as equity. Obviously, if this is 90%, let's say, and this is 10%, then equity, you don't need equity. Everything is on a debt service. So you're 100% shareholder of the business. And then what else we have here? And then it's going to auto populate basically the loan debt service, the yearly amount, and the seller financing debt service, the yearly amount, obviously based on the numbers above. And it's going to give you the total number of the yearly debt service. So if you have a 1 million EBITDA a year and almost 600,000 in debt service, then the DSCR, which you need to be familiar with if you're looking to buy a business, it's the debt service coverage ratio, is going to be 1.67. And you want to aim for at least 1.5. That's just rule of thumb. That's also the number that the banks are going to look for if they're going to help you finance a deal. The better, the higher, the better, obviously, because it's going to put kind of like help you de-risk the deal and make sure that you're not buying a risky business. Obviously, there's many more things to look at in the deal, like the quality of revenues, the quality of the business overall, to see if it makes sense to buy the business. But this is kind of like the rule of thumb of the first thing to look at. And then you could see kind of like what you're left with, right? So a business doing a million in EBITDA with this kind of yearly debt service is leaving you, the owner, with $400,000 that you could take home, obviously, before taxes. Or you could just use it to do other deals, or you take money out and buy yourself a Ferrari, but you can do whatever you want with it. So this is kind of like a very, I'd say, average deal. Like that's what it would look like. So kind of like 80% from the bank at least, 10% seller financing, maybe 5-10% equity. And those numbers can change. Obviously, some deals, especially if there's no SBA involved, then you can get up to 50, 60. I've seen deals, like some of the deals that I've done in the past were 100% seller financing, right? So it really depends on what you can negotiate. But in the end of the day, what's really important is the yearly cash flow and what you're left with, and to make sure you're not putting yourself into too much stress as far as kind of like what you need to pay yearly back to whoever gave you the loan, right? So that's why if the number here was lower, let's say, then maybe I would look to get more of an equity injection to make sure that your investors are supporting you and helping you to not put too much stress on the business and on yourself as the owner. So hopefully that's helpful. If you like that, we're going to put links below if you want our help to buy a business or to become an advisor to support acquisitions like that and get a few percentage of a deal. Let me know if you like those kind of videos. I hope you like it, and see you soon. Thank you.